Crypto launchpads minted more millionaires per square inch of internet than almost anything else in the last decade, but they also vaporized more dreams than a bad Vegas weekend. We are talking about a mechanism that took initial DEX offerings, or IDOs, from obscure DeFi corners to a multi-billion-dollar industry almost overnight. And now the question everyone is quietly asking is whether any of it was ever real. Let's rewind to 2021, when launchpads like PolkaStarter, GameFi, and Seedify were basically printing golden tickets for anyone lucky enough to get whitelisted. Projects were raising millions in seconds. Tokens were mooning 300, 400, even 1,000% on launch day, and people were genuinely quitting their jobs over this. The energy felt like the dot-com era, but louder, faster, and with worse grammar in the Discord servers. Then the music stopped. By 2022, the average IDO token had lost somewhere between 80 and 95% of its value from peak. And the Launchpad ecosystem went from champagne showers to a very quiet room very quickly. What looked like a democratized venture capital revolution started looking more like a very sophisticated, very legal, very fast rug pull machine. Now here's the structural thing you need to understand. IDOs exist because traditional venture capital is a closed club. The idea was beautifully simple. Let regular people get in at the ground floor of crypto projects, the way institutions always had, cutting out the gatekeepers entirely. That thesis is not wrong, and in fact, it is genuinely compelling, which is exactly why so many people ignored every red flag waving in their face. The problem is that the incentive architecture was completely backwards from day one. In a healthy market, founders want long-term holders. In a launchpad ecosystem, early allocators want to dump on retail as fast as humanly possible. You have got insiders with vesting schedules designed to look long-term but structured to maximize exit velocity the moment a token hits a centralized exchange. Think of it this way. Imagine you are invited to a poker table, but what you do not know is that 3 of the 5 players already know each other's hands. That is not poker. That is a performance. And you are the audience they need to make the illusion work. The Launchpad model at its worst was exactly this. A coordinated theatrical production dressed up in the language of decentralization and community ownership. And yet, and here's where it gets genuinely interesting, not everything was theater. Projects like Axie Infinity launched through Launchpad-adjacent mechanisms and created real economies that lifted real people out of poverty in the Philippines and Venezuela. Chainlink, Polkadot, and several other now blue-chip assets had early community-raised components, and the people who held through chaos did extraordinarily well. History rhymes here. Every bubble contains real companies, real technology, and real winners. You just have to survive long enough to tell the difference. The psychological trap that catches most people is called recency bias, dressed up as pattern recognition. When tokens go up 500% in a week, your brain files that under how this works rather than statistical anomaly, and then you size your next position accordingly. Howard Marks calls this the most dangerous 4 words in investing. This time it's different. And the Launchpad space has been screaming those words in all caps since approximately 2018. Here's the misconception we need to kill right now. IDOs are not inherently scams, and launchpads are not inherently evil. The structure itself, a decentralized, permissionless mechanism for early-stage project funding, is genuinely innovative and fills a real market gap. The problem is execution, incentive design, and the very human tendency to confuse access with advantage. So what do the lessons actually look like in practice? Number 1, allocation size should be treated like a lottery ticket, not a mortgage payment. Number 2, if a project's token unlock schedule makes your head hurt when you try to read it, that is not complexity. That is camouflage. Number 3, the projects worth backing through launchpads are almost never the ones with the loudest Discord hype. They are the ones where the team was building quietly before the raise. The broader cycle here follows a pattern as old as capital markets. Innovation attracts speculation. Speculation attracts fraud. Fraud attracts regulation. Regulation clears the field for the next real cycle. We are arguably somewhere between the fraud and regulation chapters right now. which historically means the genuine opportunities are just starting to become visible again beneath all the wreckage. Builders who survive the bear market are leaner, more serious, and significantly less interested in paying influencers to shill their token. Here is your actionable framework. If you are going to participate in IDOs at all, treat your total allocation like a venture portfolio, not a single bet. Spread small across many, expect most to fail, and let the asymmetric upside of the ones that work carry the math. Emotion is the enemy here. The moment you start calculating what your bags would be worth if the token 10x's, you have already lost your discipline and handed your decision-making to dopamine. At the philosophical level, this entire space is a mirror. It shows you exactly how patient you are, how honest you are with yourself about risk, and whether you are actually investing or just gambling with extra steps and a hardware wallet. The people who have made lasting money in crypto launchpads are not the ones with the best calls. They're the ones with the best process, the tightest position sizing, and the emotional constitution to hold a thesis through a 90% drawdown without selling everything and rage posting at midnight. Whether IDOs become legitimate infrastructure for early stage fundraising or fade into a footnote of the speculative era, the underlying technology for decentralized capital formation is not going anywhere. The question is never really whether the mechanism survives, it is whether you survive long enough with enough capital intact to participate in whatever version actually works. Be comfortable with uncertainty, be ruthless about position size, and never let conviction substitute for process. And whatever your next move looks like, whether it is in crypto, real estate, or somewhere in between, check out our links in the description below, where we can help you get started with real estate investing, home contracting work, and finding the right lenders for your goals.